Coming up on Market to Market. Winter reprises its role in the grain belt as record snowfall delays planting even further. The Food and Drug Administration gets the jitters over added caffeine in food and beverages. And the Chicago Mercantile Exchange tries to level the playing field between man and machine. Those stories and market analysis with Naomi Blohm next.
Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success. This is the Friday, May 3 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. John Steinbeck once said, "I've lived in good climate and it bores the hell out of me. I like weather rather than climate." If that's the case, and Steinbeck had been in America this past week, the legendary writer who penned The Grapes of Wrath would have been anything but bored. In California, hot and dry conditions fueled wildfires this week that blackened 15 square miles. More than 3,000 firefighters battled 6 major wildfires Friday. Hot, dry Santa Ana winds gusting to more than 50 miles per hour swept flames towards the coast, threatening thousands of homes in their path. And the blazes reinforced predictions that California is in for an especially bad summer fire season, thanks to snowpack that is just 17% of normal and hot, dry weather that has left the brush tinder dry. Further east, this spring will be remembered as a season of historic cold. The National Oceanic and Atmospheric Administration reports the month of April was the second coldest since 1895. And if May is any indication, the calendar might say spring, but winter isn't over just yet. Paul Yeager explains.
This week started with some delayed warm and dry conditions. The weather pattern allowed for corn planting to finally occur. But growers are still well behind the average pace, as only 5% of the corn crop was in the ground, according to USDA's weekly crop progress report. That trails the 5-year average of 31%, and virtually no corn has been planted in 4 of the top corn-producing states. The future planting progress is going to be difficult to predict, according to USDA meteorologist Brad Rippey.
Without El Nino or La Nina, it's a very tough summer to forecast. Right now, we're kind of hanging the forecast on the North Atlantic block, and if it persists, look for this cool, wet weather pattern to break down, and will trend into a hotter, drier June and July, which would not be favorable for crops because then we'd have late planting compounded with the fact that we'd be heading into a hotter, drier summer.
But the advancement was short-lived as Mother Nature humbled producers late this week with much-needed moisture in the form of snow. Another winter storm dumped several inches on the Rockies. Even for Denver residents, May storms are unusual.
It's very late. It's very late in the city. It's not late in the mountains, but here in the city it's extremely late for it to snow.
The storm made its way across western Kansas, where Market to Market Facebook fan Louise posted this photo of snow that fell near the west central community of Dighton. Another fan on our site, Michelle, near Cambridge, Nebraska, posted this picture where the moisture is adding insult to injury as the snow came too little too late for her family's winter wheat crop. Michelle reports several thousand acres of wheat have already been written off as ruined because of lingering dry conditions. The drought monitor from the University of Nebraska remains very similar to last week, with only a fractional decrease to 60.1% of the contiguous U.S. in one of the 4 stages of drought. Flooding concerns waned in the Fargo, North Dakota area this week. The Red River crested Wednesday at 33.32 feet, 15 feet above flood stage, and just in the top 10 highest crests ever recorded in the region.
Even though we have a new storm that's starting to affect the region, it doesn't look like rainfall totals will be quite enough to bring a whole new round of flooding. Yes, we'll see some localized flooding developing in some of the lowland areas, but no more big flooding like what we saw back in late April. The fact that we have subsoil moisture that's still on the short side across a lot of areas like Iowa and Minnesota is helping to soak up some of the moisture and certainly has minimized the flooding. It could have been a lot worse if we'd had a wet winter and early spring.
This week, at least 3 states set May snowfall records. In Minnesota, the southern portion of the state received the brunt of the storm. Blooming Prairie's 15-inch total will go into the record books as the highest 24-hour snowfall total in the month, normally reserved for flowers. The second state to be dumped on Thursday was Wisconsin, where Travis and Menominee posted these pictures via Twitter of snowfall at Pine Point Farms. The highest totals came from Rice Lake, where more than 17 inches fell. And Iowa producers were in the same frozen boat. Snowfall dampened recent progress with nearly a foot falling in the North Iowa town of Forest City. The National Weather Service says the last time Des Moines received more than 1 inch of snow in May was in 1907. Just hours earlier, tractors were working to get back on track with spring fieldwork. Now they just sit under a bittersweet blanket of snow, waiting for the next window to open to get back in the field. For Market to Market, I'm Paul Yeager.
Despite struggles, the U.S. economy demonstrated last month why it's the envy of every other nation on the planet. In the face of tax increases and federal spending cuts, U.S. employers added a solid 165,000 jobs in April, and the brisk hiring pace pushed the U.S. unemployment rate down to a 4-year low of 7.5%. Other developments this week also pointed to a stronger economic outlook. The Consumer Confidence Index rose more than 10% in April to a 5-year high of 68.1. Meanwhile, Ford, GM, Chrysler, and Nissan all reported double-digit U.S. sales increases last month, as strong demand for pickup trucks drove the best April for car and truck sales in 6 years. And the American Automobile Association reports the national average gasoline price of $3.55 per gallon last month reflected the cheapest gas in April since 2010. But even as concerns ease over prices at the pump, there was growing angst concerning the fuel consumers pump into their bodies. And this week, the Food and Drug Administration sounded the alarm over increasing amounts of caffeine being added to some unlikely foods. There is no shortage of products available for caffeine-craving consumers nowadays. But the introduction of caffeinated chewing gum has spurred concerns by the federal government about the well-being of children in relation to such stimulant-infused offerings. The safety of energy drinks and energy shots are already under investigation by the Food and Drug Administration, prompted by over 90 consumer reports of illness and death related to alleged misuse of energy products in recent years. The Chicago-based William Wrigley Jr. Corporation unveiled Alert Energy Gum this week, promising the right energy right now. Each piece packs 40 milligrams of caffeine, equivalent to half a cup of coffee. FDA Deputy Commissioner of Foods Michael Taylor said that the only time the agency explicitly approved the practice of adding caffeine to foods or drinks involved colas in the 1950s. In a statement this week on FDA's website, Taylor added, "Today, the environment has changed. Children and adolescents may be exposed to caffeine beyond those foods in which caffeine is naturally found and beyond anything FDA envisioned. For that reason, FDA is taking a fresh look at the potential impact that the totality of new and easy sources of caffeine may have on health, particularly vulnerable populations such as children and youth, and if necessary, will take appropriate action." In 2010, FDA forced the makers of alcoholic caffeinated beverages to cease production. The agency said the combination of caffeine and alcohol could lead to a wide-awake drunk and has led to alcohol poisoning, car accidents, and assaults. In nature, caffeine can act as a natural pesticide, where it is found in the fruit, leaves, and seeds of some plants. When consumed by people, caffeine rouses the central nervous system, which temporarily relieves drowsiness and increases alertness. The stimulant is a native compound within coffee, the second most heavily traded commodity in the world behind crude oil. The U.S. imports over $4 billion worth of coffee every year. According to a Zagat survey, the average age U.S. coffee drinkers begin consumption is 18.8 years. Manufacturers of caffeinated foods and drinks appear to capitalize on that trend, claiming their products are intended for responsible adults. Warning labels are found on many of these goods, which advise against use by children, teenagers, and women who are pregnant or nursing. Despite labels, critics argue it's not enough for companies to say they are marketing to adults when caffeine is added to items like candy, which is attractive to children. Major medical associations have warned that too much caffeine can be dangerous for kids, who have less ability to process the stimulant than adults. The American Academy of Pediatrics says caffeine has been linked to harmful effects on young people's developing neurologic and cardiovascular systems.
Next, the Market-to-Market Report.
For a few minutes last week, a mere 12 words on Twitter shook the world's mightiest stock exchange to its core. Hackers sent a false Associated Press tweet reporting President Obama had been injured by an explosion at the White House. Computers with sophisticated algorithms reacted to the bogus report and immediately began dumping stocks. And in less than 5 minutes, the computers had unloaded $134 billion worth of equity on Wall Street. Markets quickly recovered from the plunge, but the incident drew attention to the potential danger of high-frequency trading. Those concerns were evident again this week in an article in the nation's leading financial newspaper. But this time, the Wall Street Journal alleged high-speed traders are exploiting vulnerabilities in the world's dominant agricultural futures exchange. When the Chicago Board of Trade opened more than 150 years ago, the only way to make a trade was through open outcry. In the past 3 decades, however, electronic trading has begun to take over from those shouting at the top of their lungs. After numerous mergers and acquisitions, the Chicago Mercantile Exchange has become the world's largest futures exchange company and executed 11.6 million contracts per day in April. Late this week, however, the Wall Street Journal reported that gaps in information timing could benefit some traders. The newspaper said high-speed traders are using a hidden facet of the Chicago Mercantile Exchange's computer system to trade on the direction of the futures market before other investors get the same information. The report, based on information from unnamed people familiar with the matter and reviews of trading records by the Wall Street Journal, found that the advantage is often just 1 to 10 milliseconds. But that's enough time for a computer-driven commodity traders to detect when their orders have been executed, allowing them to take further action before the rest of the market can detect any changes. The Tab Group, a financial market research and strategic advisory firm, says open outcry exchanges have lost 20% of their business to the computer trades. And according to its findings, high-frequency trading accounts for more than 60% of futures market volume, up from 47% in 2008. This week, CME officials said, "Our goal is to bring variability as close to zero as possible, and we have made significant steps to address latencies related to trade confirmations." The company also stated, "Out of more than 300 million messages that come into our platform each day, there may be times when customers can experience a latency of a few milliseconds between the time they receive their trade confirmations and when that information is accessible on the public feed. However, these instances are not consistent and vary across asset classes." Friday's positive labor report was welcomed on Wall Street, where the Dow and the S&P 500 both soared to record highs on the news. Grain prices actually fell on Friday, but not enough to wipe out gains in previous sessions. For the week, July wheat gained 29 cents, while the nearby corn contract moved more than 40 cents higher. Soybeans also rallied this week as the July contract posted a weekly gain of 6 cents. Nearby meal prices followed suit with an improvement of nearly $2 per ton. In the softs, cotton prices also advanced as the July contract posted a weekly gain of $2.18 per hundredweight. In the dairy market, June Class 3 milk lost 28 cents, while the July contract moved more than 30 cents lower. Over in livestock, the June cattle contract lost 78 cents. August feeders were off nearly $4, and the June lean hog contract declined by 35 cents. In the financials, the euro gained 80 basis points against the dollar. Crude oil gained $2.61 per barrel. COMEX gold advanced by $10.65 per ounce, and the Goldman Sachs Commodity Index gained nearly 10 points to settle at 630.90. Here now to lend us her insight on these and other trends is one of our regular market analysts, Naomi Blohm. Naomi, welcome back.
Hi, thanks, Mike.
It has been a busy week. Let's get into weather. That's been the topic on a lot of people's minds. What are your thoughts on this delayed planting season we're seeing? How is this going to affect the grains as we roll into eventual springtime?
That's a great question, and certainly is top of mind right now, especially with the snow that we've had throughout Iowa and Minnesota, Wisconsin. I would say that the weather right now is definitely going to impact prices probably for another week or two on planting delay concerns, and then the party's going to be over because the crop is going to get in the ground, it's going to be planted. And historically speaking, from a corn perspective, even if there is a late planted crop, it doesn't have a specific bearing on what yield will be. Some years we've had record yields from late planted crops, and some years we've had just poor yields, and it just depends on the July weather for pollination.
For pollination as we get more into the summer. Well, let's talk wheat a little bit as we talk about how weather has affected the wheat crop, especially in America. We've seen multiple freezes. Now we've got snow. A lot of the wheat producers out there are getting nervous. What are your thoughts on wheat this spring? What are we going to see on prices?
The price for wheat, I think, is going to just continue to hold firm for now, which is a little bit disappointing, I think, to many producers. The winter wheat tour this week showed that the average yield in Kansas is 41.1. I think a lot of people were anticipating it to be worse than that. And the fact that it isn't just says that the market is going to just wait and see what the May and the June weather actually come out to be, and then we have to wait until the harvest actually happens before we know, I think, really how bad it is, which is what we're hearing from various producers throughout Kansas and Oklahoma.
Now, if it does degrade over the spring, if we do see yields be worse than we're seeing on the winter wheat tour, is that going to be much of a market mover, or is it still the global situation? Are we still a little too oversupplied with wheat to have much of an effect?
It's something where it'll make the market move a little bit higher because of wheat being a substitute for corn lately, and in that type of capacity, it'll keep the market firm. It'll keep it a little bit of an uptrend, but it's not enough to make it just rally because the global situation is still trumping at this time.
So what's your advice to producers out there looking at uncertain yields and in this time of prices?
I would say patience. Your time is going to come because when harvest happens and the yields won't be there, then I think you'll have your opportunities for the higher prices then. So I would just say be patient.
Be patient, wait and see. Well, let's look at corn a little bit. Now that's where we've seen the old crop really limit up on Monday. Talk to me a little bit what happened there. We had planting happen over the weekend, and yet we saw the market spike on Monday.
Yeah, it's kind of funny because, in April we had all been saying, the crop isn't getting planted, it's not getting planted, but the market won't care until May 1st. So we have the first week of May officially, and then we come into a horrible weathercast Sunday night and into Monday morning, and that's what pushed the market limit up. So then when the planting progress report came out at 5% planted, well, the market had already traded up, so it didn't have too much higher that it could go. And so now for this week, we'll have another slower week of planting progress shown on Monday afternoon, but the market is already expecting that. And so what's going to be a major factor will be what the weather forecast is Monday morning. And if the weather forecast continues to be soggy and Iowa and Minnesota and parts of Indiana aren't getting planted, that's going to move the market higher. But right now the December corn has some resistance at 570. It's got to get through there first, and it's going to take another weather bump to make that happen. Now I would add, if we see that price get through 570, the upside would be about 590, and that's the point to pull the trigger, because right now the market is already thinking that we're going to have about 2.5 million less acres of corn that's going to get planted. So it's already pricing it in, and the traders are already thinking that yield is going to be around 153 or 154. So the market knows that it's not going to be the best crop there, and the market for new crop will not have a reason to trade above $6 futures unless the yield starts to look like it's below 145, in which case the ending stocks would be below 1 billion bushels, but that we won't know till summer. So sell the rally that you're going to have over the next couple weeks.
Sell the upside, and then we'll wait and see if we get another weather scare.
Right, absolutely.
That's what it's going to take to push it higher. Now, as we look to producers with old crop corn still in the bin, what's your advice there? As planting gets delayed further, are we going to see better opportunities to move old crop corn later in the summer, or should we take advantage of any rallies here in the next week or so?
That's a really good question, and it's something where take advantage of rallies as they come along the way, because I think that between now and August and even early September, we're going to see little rallies that come up and then set back and then come up and set back. We don't have a reason really for prices now to go above $8 in the cash. So anytime it's close to there, I would definitely pull the trigger. But what's really going to be interesting is that there's not going to be any crop available for early harvest. So now we might see a September futures contract suddenly decide, am I going to be old crop or am I going to be new crop? And we could see some fireworks down the road this summer.
Okay, so there is that possibility, especially as planting gets delayed further and further. Now, as we take a look at soybeans, is the market anticipating a switch either in wheat acres being abandoned or in corn acres as the rain continues? Are they anticipating an increase in soybean acres?
Yes, they are anticipating it, and they're already expecting at least 1 million more acres to be planted to beans. And so people are thinking, well, why isn't the new crop bean just falling apart? And the three always stay together. And in 2009, the last time we had a delayed planting, corn, beans, and wheat all rallied up until Memorial Weekend in May, and then it was just downhill throughout the harvest. So I think we're going to see that type of a thing with the beans too. And so my suggestion would be, if we can see this corn price move a little bit higher, then I would definitely take that as a cue to sell some new crop beans in the coming weeks.
Do you have a price in mind out there that you think might be a good level of resistance to keep an eye on for producers?
Sure, it's kind of a mixed area between $12.40 and $12.50 on the futures.
Okay, all right. Now, as we look at old crop, what are your thoughts there?
That still has some tremendous support to it, and that is really being shown in the cash marketplace. The July soybeans, if you look at a long-term uptrend, like a weekly chart, it has just been holding on to this uptrend, and just for about 2 months, just wiggling around this whole uptrend line. And so $13.50 is some really good support there, and then $14 has been another target. And then on the final upside, $14.50 to $14.75 is the top of where the downtrend had been. So I would say over the next month, we'll probably see prices just consolidate in that dollar range potentially. And anytime it's at the higher end, just go ahead and make sales, because the cash market is going to give you an extra premium on top of the futures. So pull the trigger.
Take advantage of
Yes.
it. Well, now let's take a look at the dairy market. As we've seen, the dairy producers have been hammered this last year with high feed costs, and milk prices haven't been moving all that much. Can you tell us where you think dairy might be headed?
The milk market right now is most likely headed to stay between the $19 and the $20 area in the bigger picture. It's battling two major factors right now. The first is feed costs, of course, and so that is something that is watched daily. And the other little pickle that's happening is that in parts of Wisconsin and even parts of Minnesota, the alfalfa crop has winter kill, and it is dead, and it is not going to be resurrected. And so that is going to be a huge problem, because these are producers who don't have hay to get them through, and they were counting on this first crop of hay. So that's going to be another issue. And the production in the U.S. has been down just a little bit for milk. And so depending on nutrition, that may continue. The other factor with it is that the cheddar price has been actually up a little bit, but that's more reflective of what's happening in New Zealand. The drought in New Zealand is continuing, and it is really bad. And those animals are grass-fed. They're grazing animals, and so they do not have food. So that market for milk and cheese has just skyrocketed higher, and so we've actually seen a little bit of demand come to the United States, and we're exporting out. But at the same time, we just don't have a reason for the market to just go higher than 20. Yet at the same time, $19 seems to be a well-supported area.
Okay, so stagnation.
Very much
basically.
so.
But now as we look to the future, with New Zealand being primarily grass-fed, the drought is probably going to take longer for them to recover from than it would here in America, where we have a lot of other feedstuffs we can use. Does that give you a longer-term feeling of relative security on that $19 level?
For now, I think it is. And then things with that would just be dependent on feed costs here, and then just demand in America from our consumers as well. But for now, it is giving us some security at the moment.
All right. Well, keeping in the livestock vein, let's talk about live cattle. We've got grilling season getting underway eventually once the snow melts. What are your thoughts on the live cattle market?
It's been having a great week with cash prices, 206 and 207 on dress basis for cash prices in Nebraska. Box beef values the highest since 2003 this week. So that really kept the market supported. And normally those are things that would just make the market go limit up. However, this cattle market is very aware of the consumer and doesn't want to spook them, because that price can't go too much higher, because even though, you know, our economy is better and gas prices are lower, there's still a point at the store where you're like, I'm not paying this much for a steak. But at the same time, with the livestock herd being as small as it is, we've got some long-term higher prices, but most likely, kind of like milk, we're going to see the market just stay stagnant, trading weather, trading the economy, and then just kind of a sideways price movement for now.
So for producers, take advantage of those upswings. They seem to be relatively short-lived, as we've seen both in live and feeders. So take advantage of it. Be aware of where the markets are headed.
Right.
All right. Well, let's take a look at feeder cattle. Big move up last week.
Yeah.
We saw corn price spike a little bit further down this week. Is that primarily what was driving it this week?
Yes, absolutely. That's been what's happening. And the other part of it, volume has been light on the board, and we're in this downtrend. The support level has been holding, it's been holding, and then we see the spikes up. And I think we'll probably continue to see that for a while, just until we have further information on the crop situation and what's going to be happening there.
Okay. What sort of levels do you see us trading around? Is there any contingencies out there that you see us could spike one way higher or lower? What other levels of resistance are out there?
So like on the August contract, there was some support at 149, and we finished I think a little bit below there today, and now the next layer down is 147, and on the flip side it's 152. So I'm thinking we'll probably see it just kind of be stuck in that range for a little while longer. If it can break out to the upside, it would be at least, I think, go from like 152 maybe to 155, 156. And we just won't talk about the downside right now. Okay.
All right. We'll wait and see what the weather and see what this crop does. Well, let's talk hogs. We've seen hogs sort of, again, trading in that channel. Do you have news out there for producers?
It is a mixed market for hogs right now, and I think right now probably one of the hardest markets to call, because the cash market was better this week, yet overall we had record high hog weights this week, like all-time high, 2 pounds heavier than year-ago levels. And then also, if you look at the Hogs and Pigs report from March, it is showing that animals are up 1.5%. So we have more animals, higher weights, obviously more production, and the exports haven't been as strong as they've been in weeks and years past. So there's potentially more supply on the market, and definitely demand coming because of the grilling season, in theory, coming, and hopefully we'll see it continue, but sideways for now.
Sideways and with some bearish overtones.
Yeah.
All right. Well, thank you so much, Naomi. Really appreciate you being here with us.
Thank you.
That wraps up this edition of Market to Market. But if you'd like more information from Naomi on where these markets just may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, and streaming video of our program, as well as links to our Twitter feed and Facebook account, all free at the Market to Market website. Be sure to join us again next week when we'll examine the legacy of author, feedlot designer, and agricultural advocate Temple Grandin. So until next time, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by DuPont Pioneer, working with growers to match the right product to the right acre. Science with service, delivering success.